Good morning. This is Barry Knapp from Ironsides Macroeconomics. It's Monday morning, September 30th, last day of the quarter at about 8 a.m. Mountain Time. This is the introductory version of our weekly audio and video summary of our extensive notes that go out every Saturday morning. As usual, if anyone's interested in a trial subscription to read the full notes, which is our marquee product, please let us know at bcnap@ironsidesmacro.com, and we'd be happy to provide a trial to you. This week's note was global stimulus boom. And so we, as a consequence of China following up the Fed's pivot to recalibration or significantly easier policy, China announced a series of monetary and fiscal policy steps that I'll discuss a little bit in terms of the implications for global markets. We got pretty deep into that in this week's note. We also discussed a little bit of the incoming data in the U.S. around the labor market, the manufacturing sector, and housing sectors. But importantly, we had another big, significant revision last week. A month earlier, it had been a negative revision to payrolls. This time it was a positive revision to gross domestic income, an indicator we consider a much better measure of the business cycle than gross domestic product. We had expected GDP to be revised down towards GDI, which was running much softer. And in fact, it was the opposite. And so that does hold out some very significant potential implications for productivity, growth, capital investment, and income over time, and then wrapped it up with a really extensive section, or fairly extensive section, on market implications of all this stimulus in this week's note. So, as I mentioned, the data has been weakening. Last week's most significant data point early in the week was the Conference Board's labor differential, people saying jobs are plentiful, less those that are saying jobs are hard to get. That implies another increase in the unemployment rate this week to over 4.4%, 4.43 to be precise, and the underemployment rate going to 8.1%. That's been a historically very tight relationship, and it's been recovering since pandemic-related distortions, and has been a really good indicator for the last year or so, since the year and a half, actually, since the unemployment rate bottomed. But those GDI revisions were definitely significant, and they do point to stronger productivity growth. In the past, they raised the question of whether we're seeing a cyclical recovery in productivity from what typically happens in a business cycle. Initially, you see a recovery in output, then you see a recovery in employment. Employment starts to stabilize, productivity picks up a little bit. But we had also seen a secular pickup in productivity late last business cycle due to technology innovation adoption. And it's very possible with those upward revisions to GDI that we're into that stage of the cycle earlier than we expected. So just to give you specifics on GDI, the first half of 24 had originally been indicated on a nominal basis. That's current dollars at 4.5%. It's now 6%. And last year had been originally guesstimated at 4.1. It's now 5.4. So that's pretty robust growth. It was the corporate sector in the second quarter, but in the quarters before that, it was mostly wages and salaries. Now, we do have some questions about that data, because supposedly that came as a consequence of the BEA getting their hands on the BLS's estimate of the quarterly census in employment and wages that caused a big downward revision to employment growth, 818,000 to be precise. So that struck us as a little curious. But nonetheless, if those GDI numbers turn out to be indeed that strong, running at 6% on a nominal basis, that has very positive implications for corporate income, capital investment over time, and household income, obviously, as well. So on to China. They are in the midst of the mother of all malinvestment busts. There is one thing they can do that would have significant implications, and their actions hint that they may be ready to do this. And this is the chart I have in the background, which is what the US did, which was to monetize the debt, take the private sector or local government, in their case, debt, off of their balance sheet and put it on the central government balance sheet. Doesn't make the problem go away, but it certainly makes the fallout from it significantly less acute. Now, there's two global implications. It's obviously a positive for China's trading partners if the Chinese slowdown stops and even reverses to some extent. We don't expect a big pickup in investment, but at least if it stopped falling, that would be a big net positive for global manufacturing. But that also means the deflationary impulse that the Fed is overly reliant on here. Remember, goods prices are falling at a 1.75% annualized rate. If that dissipates in 25, then the inflation story deteriorates in the US. So that's probably a 25 story. The near-term implications is a potential slowing of the global manufacturing recession. So we recommended adding a little exposure to Japan. It got sold off hard last night because of the new prime minister being supportive of the Japanese normalization of monetary policy, which we ultimately think is a good thing. So we'd probably buy Japan on weakness. We'd add a little bit of exposure to the emerging market ETF, EEM. Obviously, it's run up a lot, so pick your spots there. But we would add some exposure, and ultimately, we think all this is going to be bad news for U.S. Treasuries. But it's probably too early to do that ahead of payrolls on Friday, in particular. And we do think the labor market data is going to continue to get worse, and so that probably is something of a 2025 trade as well. Barry Net from Ironsides. Have a good week. And as I said, consider becoming a full subscriber. We'd love to have you on board.